All right, today we're going to tackle a real financial mystery, one that's been around for decades, involving one of the most hyped events on Wall Street, the initial public offering, or IPO.
You know the feeling. A hot new company is about to go public, everyone's talking about it, and you ask yourself that one big question. Is this my ticket? Is this how I get in on the ground floor of the next huge success story? Or am I about to walk right into a trap? And for the longest time, the answer from the experts seemed kind of grim. A bunch of major studies all pointed to the same weird trend. If you bought shares in an IPO and held on, you are actually likely to do worse than if you just parked your money in the general stock market. But why? And just like that, you've got what finance pros called the IPO underperformance puzzle.
And it was a real puzzle because the evidence was all over the place. On one hand, you had a huge landmark study in 1991 from Jay Ritter that seemed to settle it. Yep, IPOs underperform. But then, just a few years later, another study comes out from Brov and Gompers and says, nope, we're not seeing that at all. So who was right? It was a genuine financial whodunit.
So to get to the bottom of this, we've got to talk about the usual suspects in any financial mystery: risk. But here's the twist, and it's a big one. Not all risk is the same.
Okay, stick with me here. Let's use an analogy to make this super clear. Imagine the entire stock market is a giant harbor, and every single company stock is a boat floating in that harbor. So first up, you've got something called systematic risk. The easiest way to think about this is just the tide. When the tide rises, all the boats go up. When the tide falls, they all go down. It's the big picture stuff, the economy, interest rates, that affects everybody. You can't really escape it. But then you have idiosyncratic risk. This is all about your boat and only your boat. Is it a top-of-the-line speedboat with a brand new engine? Or is it, well, kind of leaky and old? This is the risk that's totally unique to a single company. Its management team, its secret sauce, its direct competitors. Okay, and here is the absolute kicker. For decades, the standard models that all these experts were using to study IPOs, well, they were fantastic at measuring the tide. They could measure that systematic risk perfectly, but they were completely blind to the condition of the individual boats. They just ignored idiosyncratic risk entirely.
So that leads to the obvious question, right? When you're talking about a brand new boat being launched into the harbor for the first time, an IPO, isn't its individual condition the most important, most uncertain thing about it? What was this massive blind spot causing everyone to miss?
And that, right there, is the missing clue. This is where a new way of looking at the data finally comes in and cracks the case wide open. Okay, so check this out. This is the moment it all clicks. See that top line? That's the old way of doing things, the standard model. And just like before, it spits out a slight underperformance. The puzzle is still there. But now, look at that second line. This is a new, better model that measures both the tide and the individual boat's condition. And what happens? Bam! The underperformance, it's just gone. The puzzle vanishes. And that is the solution to the whole mystery. It was never that IPOs were just bad investments across the board. The real story is that many of them are individually way riskier than established companies, and the old models just couldn't see or measure that specific risk.
So that's the key, this firm-specific, idiosyncratic risk, which naturally leads us to the next part of our investigation. Which of these brand new boats are the riskiest ones in the harbor?
Well, the research is pretty darn clear on this. As a group, new public companies have way more of this unique, firm-specific risk than older, more established companies. I mean, that makes sense, right? There are just so many more unknowns. But it turns out they're not all created equal. The researchers were actually able to build profiles of the riskiest ones.
And the profiles of these super risky IPOs? Well, they're probably exactly what you'd expect. We're talking about tech companies with unproven ideas, companies that go public during a market frenzy like the dot-com bubble, firms that seem way overvalued right out of the gate, and of course, really young companies that just don't have a track record.
So what's the big takeaway here? What does this mean for anyone thinking about investing? This is the final verdict, and it kind of changes everything.
The bottom line is this. Those lower average returns we saw for the risky IPOs, that's not a puzzle. It's not a market failure. Not at all. It's actually the market working exactly like it's supposed to. Basically, what looked like a weird puzzle was just the market doing its job. It was pricing in the risk. When you invest in one of those high-risk, unproven boats, you are taking on a ton of uncertainty. And those lower average returns, that's simply the price you pay for taking that huge gamble. So let's wrap this mystery up, shall we? For years, the IPO puzzle had everyone scratching their heads. The solution, the hidden clue, was to finally measure that firm-specific risk, the condition of the individual boat. And once we did that, we saw that what looked like poor performance was actually just the market charging a fair price for taking on a whole lot of extra risk. Case closed.
So this really changes the game for how we look at IPOs. It's not just about the return, it's about the return you get for the risk you took on. And it makes you wonder, right? What other long-held facts about the market are just puzzles waiting for us to find the right way to look at them?